Bienvenidos a Invertir como un Profesional. Hoy estamos en directo después de, yo creo que más de 3 semanas, porque, como sabéis, el día 17 de abril empezamos el curso avanzado y cuando hay curso avanzado, pues no realizamos directos, dado que tenemos muchas clases, tantas como 4 a la semana, si contamos las 3 semanales más las tutorías. Por tanto, no hemos estado activos, sí que hemos estado activos con vídeos grabados y hoy volvemos en un directo porque pues tenemos una entrevista. Ya sabéis que somos el único canal que entrevista CEOs principalmente internacionales, aunque ya os aviso que he contactado con Jay Danet para tratar de traer al CEO al canal. Estoy haciendo bastantes cosas para tratar de traer pues diferentes CEOs al canal. Y hoy, aunque aún no los veo conectados, pero tenemos a la familia Flam, tanto a Jerry como a Mike, que nos van a explicar pues, la propuesta de valor de Credit Risk Monitor, de la cual pues, conoceréis porque ya hice una tesis de inversión en el canal. Por tanto, yo creo que es una compañía interesante porque es totalmente desconocida por la comunidad financiera, tiene cero cobertura de analistas. Por tanto, creo que es bastante interesante, pues ya veo Jerry que me aparece aquí abajo. Por tanto, creo que es interesante pues conocer a esta compañía. Repito, en primicia, esta compañía nunca ha hecho una presentación fuera de Estados Unidos, por tanto, espero que valoréis el esfuerzo en traer CEOs. Juan, ¿qué tal? Buenas tardes, bienvenido. Por tanto, veo a Jerry, le voy a dar paso ya. Hey, Jerry, how are you?
Hello.
Okay. Yes. Where are you located, Jerry? I don't remember.
I am in Sarasota, Florida, which is on the west coast of Florida, just below Tampa.
So, good place to live, right? Mike, hello. Good morning.
Hey, good morning.
Okay, so yeah. Okay, thank you. Well, before to start, let me write some disclaimer, first in Spanish, then in English, right? So, Invertir como un profesional no ofrece ningún servicio de inversión, servicio auxiliar, no ofrece ningún tipo de asesoramiento financiero. Cualquier opinión, cualquier análisis expresado por mí, en este caso por Jerry y Mike, pues siempre va a ser con carácter totalmente educativo y nunca lo debéis interpretar como una señal para comprar o para vender. Cualquier precio objetivo que se exprese pues es un valor subjetivo y está sujeto a los riesgos habituales del mercado. Invertir como profesional does not offer any investment services, do not offer any type of personalized financial and investment advice. Any opinion or analysis expressed here is always an entry education nature and should not be interpreted as a confirmation to buy or sell securities or any other financial asset. Let me say some key points and then we're going to start. So Credit Risk Monitor is a SaaS business that has some products specialized in bankruptcy scores and right now in supply chain. Market cap is about 30 million. Enterprise value is a little bit less, 18 million, so a huge amount of cash in the balance sheet. Last 12-month revenues reached 18 million. Component growth rate of the share price for the last 18 years, it's about 12.8%. Insider has a little bit less than 60%, institutional less than 5%. This is because I'm attracted to this company. No analysts under coverage, and the family Flam has more or less 60% of the business. So, yeah.
Hey, Quinn, can I just make one comment on that too? So within the enterprise value consideration, part of that's obviously just removing what's considered cash and cash equivalents from our, full year 2022. Just for clarity, the held to maturity, securities that are also included in our current assets, those are all short-term treasuries. So while I wouldn't classify them as cash and cash equivalents per se, they are all level 1 capital. So as far as liquidity provisioning is concerned, they're pretty quick rollers. So we typically, when we're thinking about our enterprise value, we actually typically include those, which would bring the enterprise value down by another about 4 million or so.
Yeah. Okay. Thank you, Mike. Sorry, because I want to say that because in our last conference we talked about where is the cash located. So thank you to clarify. So I think well, first thank you to be here because Jerry and Mike, I think maybe this interview is the first interview out of the US. So is it fair?
Yeah,
absolutely.
for sure.
So thank you, because I know it's not easy to have the opportunity to Spanish investors and Latin American, because all the people that is going to connect and in live or maybe in recorded, they are from Spain and from Latin America. So they value this channel because I think we are the only channel in the south of Europe that we bring US CEOs or international CEOs to talk in the channel. And the idea is because I know that the retail investor, particular investor, don't have access to CEOs. So this is a place to reach the CEOs to the people, right? So maybe we have some questions in the chat. I can put the chat in the screen, and I can write in English the question. So I think the best way to talk with this interview with us, Jerry, is you can talk a little bit about your past before going to create Risk Monitor. You are a hedge fund manager, so I think is it interesting to know your history before you start the company?
Well, many years ago, I was a hedge fund manager and ran a hedge fund, I guess, for 30 or 40 years. And the hedge fund now is really only myself and my family is in the hedge fund. I was the founder, so I was the young person who started it, and everybody else is retired. So that's how we started, and we bought medium-sized small companies, and we had very, very long holdings in those companies. We could hold them for 5 years, 10 years, 15. We did not trade. We were looking for fundamental companies that were building real companies and making the right industrial moves to grow their company. And we started this operation back in '98, and we put it into a shell that we controlled, and which was a public shell, and that's how Credit Risk Monitor got public. We've had very limited outside financing. We've grown it internally, and we've developed our own cash. And as you can see from our balance sheet, we've not only grown the company, but we were cash flow positive and generated a lot of internal cash. And so we run the business as a real business. We are not of the new vogue of growing the company at a very rapid rate and losing lots of money. That's not our style of how we build companies. And our criteria for buying small company stocks over the last 40 or 50 years was if you're going to buy a small company, then you got to deal with the durability of that company. In other words, you got to be willing to be invested for a reasonably long time, because as you get a position in it, you become an owner, not an investor. It's very hard to sell stock in companies when you take a big position in a small company. And so with that in mind, our view was how you did it was you got reoccurring streams of income, which we have because we are a subscription business, and also a very strong balance sheet, and we're counter-cyclical. And so these are the things that allow you to have the time to build and develop a real company. So that's the background.
Okay. Could you explain a little bit the decision to buy the Great Score company? Where I think the name is not the same before, right? Or I think the assets, right? So could you explain a little bit that?
What happened was we dropped it into a shell, which was called, let me see, I guess New Generation Food. And we used the shell, and we also had a tax loss carry forward in that shell. So that was helpful because we were able to maintain some of that tax loss carry forward. That all occurred back in '98, '99. And That's the background in it. And because I said to you before, for me, when I looked out on the world in 98, 99, I was looking at a world which is basically the harbinger of where we are today. We are in a very over-indebted, very, very heavy bonds and debt all over the world. And so we are very much concerned with that there will be some very, very slow growth or possibly a major contraction on the horizon. And we wanted to have a company that was counter-cyclical.
Okay.
Just to add on to that though, so the assets, if you will, come out of the hereditary market guide Moltex company, right? So that's where credit risk monitoring was. Obviously, that's kind of makes the basis of what Jerry folded into the shell. So they were operating that for a few years and really weren't able to turn that particular division into a profitable or interesting kind of department, which is why they were looking to offload it to Jerry. So just for context, he came in to evaluate the firm and actually ran it for, Jerry, correct me, but almost a year just to assess the business before deciding to move forward with the purchase.
That's correct. It was a very small little company. It was doing about $300,000 or $400,000, losing lots and lots of money, and so the parent company just wanted to close it down. So that's how we got involved in it. And Michael's right. I spent almost a year running that company for free before I made my determination to buy it.
Okay. Jerry, you talk about countercyclical. This is my third question. Could you explain with your own words what means a countercyclical company? Because in my understanding, many people don't understand what is a countercyclical company. So could you explain it?
Oh, sure. It's basically a company that does well when the economy is either slowing or contracting. In other words, its service or its products are needed more importantly when things are getting slow. In our company, we compete with Dun & Bradstreet. So we are doing credit risk analysis, and think about it this way. If you go out and you buy a business-to-business product, the company that manufactures that product will send you the goods. Let's say it's $5 million worth of widgets. They send the widgets to the buyer, and then they send a bill to the buyer. You owe us $2 million, $210 net 30 or $250 net 90 days. And so there's an extension of trade credit. And so the risk for the seller is whether in fact that company will pay for the goods or whether it will pay for the goods in a timely manner. And our analysis is to determine if in fact that bill will be paid and be paid in a timely manner. So when things get a little slow in the economy or contract, corporations and companies are more willing to spend money to assess the risk of payment, because in a contraction, not only do margins come down for everybody, but if you have bad debts, if your pre-tax margin or your after-tax margin is 10 or 11 or 8%, if you don't get paid, then you're going to require almost $10 of sales to make up for that loss. In addition to which, we analyze the working capital of corporations. And when companies start getting into trouble, the shortest tail, most risky part that will tell you how bad that company is going to, or how difficult the times are going to be for that company, will be the working capital, because very few companies have excessive cash in working capital. So if they don't get paid, they themselves are going to go out of business. So this is something they spend much more time and effort on when they begin to get concerned about the economy. So our business will do well in contraction of an economy, that's why it's called counter cyclical.
I think one other thing to point out there is, kind of a shorthand for investors has to do with looking at the beta of the stock, right? So obviously, when you look at our beta, it's fractional instead of being above one. So that gives you an idea about how correlated we are with the general markets, right? So when we think about countercyclicality, we think about the fact that we're somewhat uncorrelated to the rest of the market, and that provides downside protection.
Okay, this is how I read your company because when I think in a portfolio of assets, in this case shares or companies, I always want companies like us that could be countercyclicals. In this channel, I was talking about Paysign. Maybe you know this is a US company that they benefits from recessions and when the economy is going to decelerate because, as you know, the plasma donations are paid in the US. So as people loses the jobs, as people contract the salary, they used to go for plasma donations 2 times a week. So it's not easy to find these companies, and I think your company is one that goes in this group. No, so we go later to this concept. So right now, I like to talk about the competitive environment. You know that Dan & Breakfast is the main competitor in the US, has 80% market share. They have his own problems, but Jerry and Mike, could you explain a little bit the competitive environment, where you are and against you compete as a way to understand for people that is connected?
Sure. Okay, Michael, why don't you give a little bit of background on D&B?
Yeah, I mean, so D&B is kind of the 8,000-pound gorilla, if you will, in this market for credit worthiness and counterparty B2B creditworthy, scoring and analysis. So they kind of function under a variety of different business lines. They have a financial risk business line, which is very similar to kind of what we do. They also play in the supply chain markets, again, a place where we've opened up with our new product, Supply Chain Monitor. And kind of the third avenue where they play is really within the sales and marketing data space, master enrichment, et cetera. So, they've been in operation now for over 150 years. I think they started up in 1861 or so. So they've been a very long-term business. They've been collecting trade payment information, which, I think has a much bigger use within the U.S. markets per se than it does necessarily in the European markets. You guys have the European country registries. So specifically, there's a lot of private companies that end up having to file financials anyway. So that's been a lot of the basis for making financial creditworthiness decisions, I think, in the European market, less so using payment information where that hasn't really been collected per se until recently. In the U.S., obviously, for private markets or for private companies, there isn't a reporting space where you can get financial information other than actually getting that company to turn it over to you, right? So the use of payment information as a proxy for creditworthiness is a little bit more established in the U.S. And that's really where Dun & Bradstreet has made its name because they've been collecting this data for, years and years and years. So I would say, they kind of represent the monopoly in the business too. They've got about 80% of the market share. And, from our perspective, that's part of why Jerry got into this business to start with. When you're thinking about being a disruptor, obviously having a monopoly as the person that you're competing against can be very effective because the only reason to really be a monopoly in our mind is you want to be able to charge excessive prices, right? I mean, that's typically what you see in a monopoly. And then on top of that, also to deliver suboptimal service, right? And we got that from almost every client that we speak to, which is, while they need to have D&B because they have to have coverage, they're not particularly happy about the service level that they get or the information that they get in many cases. And I think you see that in a lot of the data that actually came out in the Great Recession. So one of the ways that we kind of compete with them is a focus predominantly, at least early on public company analysis relative to privates. So it's a much smaller universe of companies that you could be looking at for counterparty risk, but obviously there's a lot more data available. So we personally don't mix in payment information. Anecdotally, we're collecting now ourselves about $3 trillion annually of payment information from subscribers and non-subscribers, which powers some of our private company scoring models. But we don't mix that in for public companies because what we found is that public companies essentially cloak their payment behavior as they get into further and further distress. And this is actually something that DNB coined as the cloaking effect, because in the Great Recession, they had a lot of public businesses that ultimately filed for bankruptcy, but were showing very prompt payment behavior right up into the point of filing. So people that were doing business with those counterparties essentially didn't see them as a bankruptcy risk until it was too late. And the rationale behind that is, listen, if you're a CFO and you know that 80% of the market is using something that DNB is producing that leverages payment information as the signal, you don't want to send a negative signal in terms of payment behavior out into the market, because then your suppliers will start cutting off your inventory and your services, which really breaks your revenue chains, right? So you need to keep that going as long as you can for runway, so you can hopefully restructure the business and get out of the hole that's causing financial distress in the first place. So we don't mix that into public company information, because we think it's actually it's a confounding signal. It makes it actually worse to use for predictions. So, I mean, as far as the competitive marketplaces is there, that's really our niche. You know, we get in there and we provide more accurate scores than DNB, and we only cover businesses where we think it really makes sense to do credit analysis. If you're talking about doing a transaction with a local bakery or something that's, you know, maybe 10 grand worth of product, it just doesn't make any sense to do a whole lot of credit analysis and collection work on that. You might as well use something like a credit card and put that off onto Amex or onto Visa or onto MasterCard. You're going to pay, you know, somewhere in the 3 to 4 or 5% range in fees, right? But to the same extent, you don't have a credit review, you don't have a collection process. Those typically cost you much more than that. So that's kind of our, you know, that's the collective space. We also obviously compete with some other folks that may be familiar in your you know, environment, like quote unquote the credit safes of the world, you know, Bureau van Dijk. Obviously, those are other names that I think are very prominent in the European spaces.
So as a summary for this question, we can say that the product of credit risk monitors, or the idea is to try to increase market share, because the leader, who is DNB, cannot increase more because there is a monopoly and has 80% of the market, and to increase market share with a lower price, because the prices of DNB are higher than yours. So two difference. And I think the third is that your company never buy data, right? So is it true that?
Well,
I would just
Mike.
say no. We do buy data. We are an aggregator firm, so we take information from a variety of different third parties and bring it all into a central reporting structure where you can get access to all of it. So, like, you know, we definitely bring in data from Refinitiv, for instance, for some of our financial information. You know, we have relationships with LexisNexis, with Moody's.
Sorry, Mike. I'm saying that so your company are not buying data from your customers, right? From trade receivables.
No.
And trade directors. There's a big difference with DNB, right? So could you explain that?
Somewhat. I would say, you know, DNB is an interesting case. I think you see it more so in some of the other competitors who go out and purchase trade payment information from, for instance, the NACMs in the U.S., the National Credit Association. So they all have groups, essentially locational groups that deal with particular industries, if you will. And that's how they do their reporting and how they kind of get insights over to credit managers that work in that industry, right? Because a lot of this is about understanding the risk of your competitors and also, you know, your common customers. So in those cases, there is a lot of data that's purchased from the trade receivable standpoint, and that's difficult to deal with, because oftentimes there's confidentiality requirements associated with providing it, right? So if I'm giving you something that's like my customer list, how much business I'm doing with each one of them, and how well those customers are paying over time, it's really, really confidential information that most businesses don't want released, right? They certainly don't want their name attached to it. So when you buy credit data like that, what ends up happening is you really don't get an insight into who the provider is. It's really just an insight into who the customer is, right? And how well they're paying. So what ends up happening when you do that, and one of the reasons that we don't, is that you end up almost double counting information, because a lot of times you get the same line of trade from a variety of different sources because it's being reported by that company to a variety of different sources. So when you try and bring all that back together, oftentimes you can have that same line of trade being repeated within the aggregation. So it ends up destroying some of the efficacy of the data, if you will. We've never done any of that because to us, keeping that trade payment information pristine is really one of those crown jewel data assets within our balance sheet that's not really anywhere on there, right? We don't capitalize it, but we've spent millions and millions of dollars building it over, the last 15 years, right? So it's been expensed through salaries and through, development costs, but that's something that isn't anywhere on the balance sheet, but represents probably more than the enterprise value of the entire business right there.
Okay. Are you tracking, or can you share with us how is evolving your market share from I don't know, 5 years ago to right now? So are you tracking that? So I don't know if this is a public number or you can share with us.
We don't actually report on our market share, but I will say, obviously, you can see what's going on from our revenue growth. So, at the same time, if you compare that to DNB over this period of time, you can look at what their financial and risk department, which is, I think, the best way of kind of comparing us to a particular group there. Over the last 10 to 15 years, they've been really flat to down within that particular segment. In comparison, we're growing at minimum 5%. So we are taking back wallet share there. I wouldn't necessarily say that we're trading out logos, because to the same extent, our main way of getting into the business is not necessarily stealing a DNB customer per se, as much as it's taking some of the DNB cost away so that they can lower their DNB fees. I think we talked about this on a previous conversation, but we actually share about 80% of our clients with DNB. So we're essentially, a service provider that allows people to reduce their spend with DNB. So that's really how we think about taking market share from them.
Do you expect to report more data in the next quarters, in the next years? Because and I like a lot the companies that they give me KPIs. I think is it for fund managers, for analysts, follow companies that give me KPIs? In your company, is it really difficult? So do you expect maybe as your company has more visibility to try to give more data to the people?
I suspect eventually we will need to provide more data, but to be honest with you, Quim, part of the reason why we don't do it more readily now is that most of our competitors, with the exception of really DNB, are private companies. And so the biggest problem that we run into is when we start getting very detailed in our reporting, our competitors actually use that against us in marketing, right? Yeah. So it's one of those things that we take very seriously, because honestly, it's less so about having traceability from the analyst perspective, where you guys can actually say, hey, this KPI didn't move this way, or XYZ, can you explain why or what you're doing to mitigate it? And more about trying to protect some of our proprietary data, if you will, in terms of how we operate.
Okay, makes sense. Let me ask about your products. Can you explain a little bit your main products, the number of customers that you have? Maybe if you can, the average revenue per customer, your pricing model, retention rates, churn rates. So talk about to make an easy way about how can I compute the revenue line?
Yeah, so we are a business that has kind of like two main product platforms. The second one being the Supply Chain Monitor platform, which we launched in May of 2022. So we don't break that one out yet. It's still in its go-to-market phase as we're kind of tinkering it into the market. But we have the Credit Risk Monitor platform, which predominantly serves the trade credit side of this market. So essentially, that would be suppliers or vendors who are looking at their customers for creditworthiness of underwriting an AR transaction. And so we provide a variety of different analytics within that, between our Frisk score, which is our public company analytic, or for private companies for which we have financial statements. That score, is a generalized additive regression model that takes in information from the stock market, the financial statements, agency ratings from Moody's, Fitch, DBRS, Morningstar, as well as our proprietary crowdsourcing component, which is essentially looking at the aggregate usage behavior of our subscribers over a look back window of about 12 weeks or so. So what we're doing with that is we look at the relative aggregate clicks within a subscriber set of users. We actually ran an independent bankruptcy analysis on that to see whether that data was indicative. And it's independently predictive of bankruptcy because credit managers, at least in the US, are outside of SEC fair disclosure. So in contrast to you as an investor, right, who calls up the CFO and says, hey, I want to understand what's going on with this product, intra-quarterly. He's going to turn around and say, I can't answer that question the same way I'm going to tell you I can't answer some of these questions because I don't want to put out an 8K about it, right? At the same time, you can't really use that as the excuse for the credit manager because the SEC gave them a waiver, mostly because they came back and said, if you don't let us have these conversations, we're not going to be able to underwrite AR. And if we can't underwrite AR, it's going to really, screw up the liquidities of that market. Just for context, the trade credit space is trillions of dollars, right? I mean, we talk about having 3 trillion of it annually, but it's, at least in 96, it was already 3 times the size of bank loans in the US, right? So this is an enormous market, and it's kind of the lifeblood for most working capital. So this is really what keeps kind of the flow of commerce going. I think the WTO said that something in about 90 to 95% of all international trade transactions involve trade credit issuance, right? So this is an enormous market.
It's enormous.
Can I say that trade data is the new gold? So because I want to talk a little bit later about the macro picture, but it seems that as the macro is going to decelerate and recession becomes evident, trade data makes really interesting for all the companies. Right?
Yeah, for sure.
Very important.
So just to continue on, I mean, additionally, we also have a private company analytic that works for North American privates covering about 330,000 between the US, Canada, and Mexico. That score is capturing about 80% of all reported bankruptcies at least 3 months before they file. Correspondingly for the Frisk, I don't think I mentioned, but it's capturing 96% of reported bankruptcies. So best in class, performance as far as accuracy is concerned. The other thing about the PACE score is, based on NACE Association data, which is really more for the US market particularly. When you look at the classification that they get from IRS reporting, basically on the breakdown, we think we're covering anywhere from 90 to 95% or so of US private businesses that have 5 million or more in annual revenue. So these analytics really are focused on those large scale providers of commercial transactions, right? Big private companies and obviously public companies. And that kind of makes sense because our clientele across both platforms, we've got nearly 40% of the Fortune 1000 plus thousands of other large businesses worldwide as existing subscribers. And most of them are doing, transactions with businesses that have the capacity to supply them. And so when you're talking about big businesses, they're typically working with other big businesses that have that capacity. So by proxy, the trade information that we receive tends to be much more skewed towards larger private businesses than it is, those local bakeries like I was talking about, right? There you're going to have one line of trade from 5 years ago. And, DNB will give you a report on that and say, hey, here's the credit limit for it. We look at that and say, quite frankly, you might as well flip a coin and make a decision because that information is it's not signal, it's noise, right? It's giving you that false sense of understanding on a private business that doesn't really, I could give you a random number generator and you would do just about as well, right? Generally we also redistribute a lot of information. We have a robust news service. We pick up news from hundreds of thousands of sources all over the world. We really scale it for materiality and for entity recognition, and then we deliver that information to subscribers in real time. So you can have those as push alerts, or you can have them as daily digests. But there's a variety of other things that kind of offer off of that platform as an add-on, such as coverage enhancements, where you can add in private European coverage from some of those Euro private registries that we were talking about. So we enhanced that back in 2021. We added that product. It gives you access to about 9 million other private businesses worldwide with scoring models. We also have private company financial solutions where if you are a private company or you're working with a private company and you happen to have buyer power or supplier power, you can compel them to give you those private company financials, similar to what banking institutions or insurance companies would be doing. So we'll take that in, we'll OCR scan it, map it to our account lines, actually give you scoring models from the Frisk score and the Altman Z score, as well as full spreads on the financials. So, there's a variety of different ways to interact. The supply chain platform has some additional add-ons beyond those things with, some enhanced peer analysis for alternative supplier discovery. It's also got the economist intelligence unit, macroeconomic data that kind of gives you insights into the geopolitical risks. We're also, working on establishing things like, for instance, the small business certifications, minority-owned business associations, things like that are more ESG functions for reporting, because that's another consideration, as well as cybersecurity. But again, I would say if anybody does want to learn a lot about the products, we did just launch our new website back in February, which has a lot of details on all of this stuff. So if there's anything in particular you want to learn about them, I'm more than happy to speak to that. But in general, those are kind of our two major platforms, and they work as kind of a hub to allow us to get into upsell and cross-sell of some of those add-on products.
Do you expect to disclose the supply chain income or revenue in the next reportings, or you are aggregating with one?
I don't think we're going to do it in this next year, just because, again, I think part of this is protecting that data from our competitors, especially where there's a lot more competitors in the supply chain space. Our hope is obviously to start breaking it out soon, because coming from a lower revenue base to start with, it's going to have a much higher growth rate associated with it. So it's one of those things that actually can be, I think, somewhat accretive to the business for us to start reporting on it. But we also want to protect the go-to-market strategy with it a little bit. So I know that's really a non-answer for you, but at least in the short term, we're not going to be breaking it out.
Okay, and we arrive at the key question. So what's the difference from today's environment to the last financial crisis? So can you explain a little bit the difference? Do you think that your company is in the best possible environment right now? So what do you feel about that?
I think it's starting. There's no doubt about it. The excesses today worldwide are are much more powerfully negative than they were in 2008. The amount of debt around the world as a percentage of GDP, or just the raw numbers of it, are much higher than they were in 2008, and actually even higher than they were in 1929. And so the world is in a debt crisis. This is a very different crisis than an overvaluation of markets, of equity markets, which it may well be also. But the real key here is a debt. This is a debt crisis, a debt and loan crisis. And these are very, very powerful, and they are going to be, when they impact, they will impact on scale. And quite truthfully, we believe it'll be probably over the next 5 or 10 years, probably a very not great economic environment. And people will have to spend money analyzing what their risks are. That's their supplier going out of business, or their supplier not making a lot of money and therefore not spending money on R&D, on quality control, or new plant expansions. And on the credit side, for sure, you will have to be watching your customer base very, very closely. Also, on the supplier base, something else is happening, and that is because of the breakdown in the relationship between China and the U.S., and also between Russia and the Ukraine and the rest of Europe. There are an enormous amount of sanctions and tariffs and all kinds of stuff. So it is appropriate for mostly every company in the world that has large production coming out of China or parts of Russia that they have to move this production because you can't take a risk that an embargo or a tariff will come in and all of a sudden a significant part that you need in your end product will not be available. You can close your whole factory down. So the risks are very powerful. And our service allows these purchasing departments all over the world to be able to take this whole big task of finding new suppliers and prioritize it. There's no point in sending your teams all over the world to look at companies that are financially having difficulty, because as I said, they just won't have the wherewithal, the financial strength to put money into R&D and into a new plant and equipment and quality control. So this is a separate part of even the credit risk that's around. So our two major products have a lot of wind at their back right now. And so in the next 5 or 10 years, we suspect will be very, very, very good for Credit Risk Monitor, probably not great for the rest of the world.
So
if I can add one to that too, I think the other thing to maybe make a distinction on, and I think it's kind of a funny thing because going into this now, mounting banking crisis, if you will, at least in the US, right, and certainly in Switzerland, every analyst in the world was talking about how don't worry about the financial markets this time. The financial institutions are all okay, right? Because essentially using the held to maturity valuations of all of these securities that they issued in ZIRP, conditions. So as interest rates go up, obviously their quote unquote stability is, for lack of a better term, bullshit, right? So I think the difference here, when you think about, the location of this particular crisis, obviously it's happening right now within the financial market or the financial institution space. But in general, most of the debt that's been issued, you have the exact same problem in the non-financial space, right? They're the ones who actually took on the debt, turned it around and used it to do buybacks for the most part, at least in the public markets, right? That's what you saw. They weren't taking on new bond data or new bond currency, right? They weren't taking in a bunch of cash and using it to finance projects that were essentially based on, hey, this cost me, 3-4% in interest expense. So if I can make more than 3 or 4% in a, return on investment for a project, I'm okay as a business. That wasn't what they did, right? The money came in and immediately went back out the door to the investor class, which is great for the investor class, but terrible for the companies. So when you look at many of these businesses now relative to where they were at the Great Recession, I would actually argue that their equity structure is even more of an upside down pyramid now than it was when we went into the Great Recession, right?
And I'd like to add one thing here too. I think there's a huge difference this time between 2008 and 1929, if you want, or 1972. And that is, normally the amount of debt that goes into a society, whether it be at the government level, whether it be at the corporate level, whether it be at the personal level, the major thing that prevents debt from getting super, super, super excessive is interest rates. In other words, the natural predator in the forest is a wolf, which prevents the reindeer from overtaking the whole world. In bond or in loans and debt, the natural predator is interest rates. And the governments of the world, all over the world, put their fingers on the scale and lowered interest rates. And we got the negative interest rates. And so what happened was huge amounts of debt got sucked into the economy because of that. Now the holders of that debt have their debt, that the paper they're holding, and it's at very low interest rates. And as interest rates now go up, that paper is going to come down. So what that means is the following. Not only are the lenders in serious trouble, are the borrowers are in serious trouble, but this time around the lenders are in serious trouble because the paper they own is going to go down 10, 20, or 30%. And many, many of them are going to go bankrupt. That's what's going on right now. It's going to be in insurance companies. It's going to be in pensions. It's going to be in 401ks. It's going to be all over because that paper is owned. And that means
Jerry, sorry for your words. What I'm thinking is that do you think that the today environment, is it much better for your company that it was in financial crisis? Is it fair?
Oh, it's much better for our company. I mean, look, Quinn, this is a hard thing to say publicly. People are going to have a lot of trouble. And this is going to work out well for our company. And while that's true, it's not something I want to go yelling and screaming around all over the place. Because, hey, listen, we're concerned for the world. We're part.
Well, there's one other thing to look at on that too, which is, look at the relative actual bankruptcy rates that are going on, in the last two years, pretty much since 2020, when we had a spike, which was all COVID related, right? But if you look at what's going on in bankruptcy rates in 2021 and 2022, they are at the lowest levels in recorded history, right? Now, part of that is, a technical functionality that it's impossible to go bankrupt when literally the bankruptcy courts are closed, right? I think we talked about this on one of our previous conversations, which is, how do you go bankrupt in the European market when you physically can't file, right? That's not an option available. So that's obviously one component, but it's the same sort of a thing happened in the US where you have government interventions like the PPP program and, the employee retention program. All those things are keeping bankruptcy rates lower than they would probably be naturally, the same way that Jerry's talking about interest rates being artificially low.
Yeah, in other words, if you owe money, and we analyze this all over the world, and 30 to 40% of the public companies out there are zombies, and basically what they don't have enough income to pay the interest on their debt, much less refinance the debt. And they're able to they were able to get so much debt in place this time around because interest rates were artificially depressed. So people were lending money to companies more and more, and these companies leveraged up beyond scale because interest rates were artificially depressed. This is the first time in history that I could ever, what I've studied and looked at, and I even remember, look, I'm an old guy, so I've been around a long time. I've never seen anything like this.
And those businesses are being cut on both sides too, right? I mean, just to keep in context, right? Part of what we're talking about with a recession is actually a decline in the revenue top line functions. So as that comes down, earnings are coming down at the same rates, right? Typically. At the same time, you're seeing your interest expenses go up as you're trying to refinance. So you're literally getting, a hollowing towards that middle where all of this is going south for those businesses that are already zombies. I think you're going to see a massive burnout. It's going to look like a wildfire in capital markets to try and take all this, allocated capital that was put to places that it really shouldn't have gone, and seeing that really being reallocated into businesses that make sense.
And I think that we all have to remember that at the end of the day, in the world economies, these low interest rate loans are parked in pension funds, they're parked in banks, they're parked in index funds, they're parked in mutual funds, they're parked all over. So what's going to happen is people are, when they finally begin to understand what's happening to their assets in these places, they're going to realize they have a lot less money than they ever thought they did. And that's going to make demand come down. They're going to buy less shirts, less cars, less bow ties. And because their wealth is going to contract on scale. And that's going to be at the same time that the debt levels are up and interest rates are going up. It's going to be a very difficult time for the corporate worlds and the government worlds out there to grow and survive. And that's why our products are going to be so important over the next 10 years.
Yes, Jerry, I understand that your moral thing, and I like that you talk about that, because it's not really good that when you perform well, the business and the world is going to decrease. So I understand that. But people here in the chat, they are looking at the past, they are looking at the performance of your company in the last financial crisis. And is it obvious that your revenue growth and your margins are improving in this environment? So this is,
yeah, look,
I'm asking about that. Right?
Quinn, in 2008, 2009, our business exploded.
I can hear, right? So you can see, here. This is revenue growth and then
Yeah.
and operating margins, right?
Yes.
Right.
Everything exploded. In fact, it grew so quickly back then, it caught us by total surprise. And we had difficulty dealing with that much business coming in the door. And so we've really done the last couple of years, we've really built up the infrastructure of our company. It's a much bigger, stronger company because this is going to be a storm. This is a tidal wave coming in. And at the same time that this tidal wave is coming in, most corporations around the world, because risk has on the last 10, 15 years has gone away or not as important as it used to be. I don't believe that you'll find that most corporations or government have enough people, trained people, and trained resources on the barricades to fight off this tidal wave coming in. It's going to be a big, big tidal wave, and it's going to come in precisely when most people are under asset-wise and under people to protect themselves. So our service is going to be critical to these people, to these companies and people. And so, look, we didn't plan it this way. I don't want to tell you that we plan these things. It's government policies in the last 15 years have just been, I guess there's no other word for it. It's stupid.
Yeah. We have a good question here from Javier Fernandez. He's asking, as the service you provide could be considered your company an advanced indicator of a recession?
Yes, clearly.
Yeah. There's one other thing I just want to point out, though, is that, the main focus of our business is in predicting bankruptcies, right? So one thing to keep in mind as an investor here is that you guys are not trying to ride a security down the bankruptcy tunnel, right? You're trying to get out before a default occurs, right? So I just want to be very clear that when we say a leading indicator, it's certainly indicative of macroeconomic trend. I wouldn't say it's a leading indicator in terms of a security default perspective, because only about 1 in 5 defaulting businesses will eventually file for bankruptcy generally. So it's a leading indicator in terms of macro concern. I wouldn't use any of our scoring analytics, if you will, as a leading indicator for an investor use case per se. We actually think that's more interesting on the other side of the market, where you've reached a nadir. So you're at the bottom of the market. Now you're trying to figure out who's going to be able to survive coming out of that nadir. And that's where our analytics are really helpful for showing those businesses that are going to get access to that free working capital from their suppliers. You do that where you don't have to get capital from equity markets or from PEs or from credit funds, et cetera. There's a much better chance you're going to be the one that comes out of this and can be a 10-bagger.
Yeah, and that's part of our data that we're collecting. Our company is issuing interest-free trade credit to various companies, and we track that. So at the bottom of a recession or a depression, or at the bottom of a major market contraction, how do you pick, which companies are going to survive? Clearly, we're going to see that, because those companies that survive will survive because their suppliers are willing to finance them, and we have data on that. So it's using us as a stock market play is somewhat counterintuitive a little bit. But I can tell you, as the original question that you asked, it is absolutely clear that as the economy really goes into a tailspin, you'll see it in our numbers.
Okay. There are more questions here. Later, I'd like to talk about your cost structure. So could you explain a little bit which percentage of your costs are fixed, are variable, to understand your cost structure?
Okay. Well, for the most part, our costs are somewhat fixed because we are an electronic company. We don't have inventory. We don't have manufacturing plants. We're a totally electronic company. So, we have rent and we buy hardware, we have electricity, insurance, that kind of stuff. The variable part of our business is as more business comes in the door, new business, we pay substantially more commissions to our sales staff as new business comes in. But our re-sign rate, which was a question you were going to ask, without disclosing it, because we don't publicly disclose it, I'm telling you that our re-sign rate is in excess of 90%. But when we re-sign companies, we don't have really such very heavy duty commission structure. So the bigger the re-sign, and it gets bigger every year, the more profitable the company becomes, because the costs on re-sign are very, very lower, much lower than they are on new signs.
I jump into the fish for the SaaS model, right? For those of you guys that are investing in SaaS companies, that's where you kind of crossed over the fish, right? It's where the residual business ends up being the major profit center.
What can I expect in terms of SG&A as percentage of total revenue for the long term? So you are 50s, no, 55% more or less. So can I expect to be flat down?
You know, it's a great question. And we would expect that SG&A and fixed costs will grow substantially slower than sales, but we don't know because our company is we're an seem to lead kind of company. What I mean by that is we are always in the marketplace testing, and we are always in the marketplace tinkering. And we're out there and we find new things and that could lead to explosive new products or new approaches. And we follow that stuff very, very closely. We're opportunistic because we think that long range or 5-year planning sounds good on paper. But for the most part, the best strategy is to continue to listen to the market and let it talk to you and tell you what new products you got to bring out, what new selling propositions you have to put in the marketplace, what's your approaches. We are very market responsive.
Okay. Is it clear what is your bull case for your company? But I like to know which one is the worst case. And I said the worst case is that the Fed start to decrease interest rates again to negative numbers, start with expansion politics, and zombie companies continue to lie for the next 5 to 10 years. This is the worst scenario, Jerry and Mike.
That's a bad scenario, but I also would like you to remember that we're coming out now with a product which is Supply Chain Monitor. And by the way, before we came out with Supply Chain Monitor, roughly 20 to 25% of our business was in the supply chain with our existing software. The software sales in the supply chain are a little differently driven than the ones on the risk side. The ones on supply chain are clearly about risk, but there's a wholesale re-geographically positioning corporations all over the world to get out of Asia and to get out of Eastern Europe, or wherever there is tumult and wherever there's the potential for war, wherever there's the potential for embargo. So there's a wholesale move. Now, when companies have to move their entire supply chains, or a really big part of it, they don't have the staff sitting around to go all over the world and find new suppliers, because every time a buyer is going to be talking to a seller in the next year or two, I cannot believe that the buyer is going to say, where is the product I'm buying from you being manufactured? Because if it's manufactured in Asia or in China, you have to be crazy to have a huge commitment there, because there could be tariffs, there could be wars, there could be embargoes, and if you can't get critical parts for your product, you have to close your factory down. You can't sell a car without a starter. If you don't have a starter, the whole factory closes. Yeah. So, all of a sudden, there's been a shifting for us. And that was designed by us to make sure that we had multiple revenue streams coming into the company. And
so right now you have a better product mix that you have in 29, right?
Much better. Look, we spent 3 years and we pumped millions of dollars into developing this new supply chain product. I mean, we investment spend in our company. We are, as I said to you before,
that you're going to see in the side chat, right? The other thing we don't really do though is we're not talking about capitalized R&D when we say investment spending.
yeah,
right?
Everything. We do not. The only deferral you're going to see on our balance sheet right now is you're going to see deferral for subscription income. We expense everything. There's no surprises, and the reason for that is we believe once you buy into our company, you are an owner, not just an investor. And therefore, you got to feel comfortable that there's no financial maneuvering or hanky pank, that these guys are building a company long range and a solid company. And listen, we're the largest owners of this company. So if you look at the salaries that Mike and I take, we're not the highest paid guys in our company. And because our guys in our company are terrific managers and terrific employees, and we don't feel the need to pay ourselves more than they get paid. We pay for the value added. So we're a long-term play. That's behind us. We're not a stock market play. We're not a hot stock. In fact, we went to our first investment roadshow last week in the history of the company. And in fact, in our interview with you, Quinn, is the first foreign interview we've done with anybody. And
Jerry, do you think that the market today understand better your company than in the last financial crisis? So are you doing something to try to be more visible about your business than the last financial crisis?
Yes. Look, Quinn, it's harder not to be noticed as we get bigger. In other words, more and more people are coming to us. And I think everybody's saying it. It's such a great story. At the moment we see revenue starting to pick up, then God Almighty, we're going to try and, participate in ownership. The problem with that is it's a very thin stock. You can't wait until everything happens because it's not easy to buy. You got to be patient and you got to take your time. In my hedge fund, it could take me, a year or two to establish a major position in a company.
Okay. Do you have some Spanish customer with your base score or any of your scores?
Oh yeah, we follow Spanish company. We follow 50 to 70,000 public companies all over the world. And we follow private companies in Europe. I guess, Michael, we have 3 to 5 million now private foreign companies with data.
We've got 9 million that we are following private European. I would say there's Frisk scores on about 325,000 and about Z scores on about 1.2 million of those. Obviously, depending on the size of the business, the reporting requirements with the registries change a little bit. So, in order for us to do a Frisk score, we're going to have at least a balance sheet and income sheet statement in order to actually do any ratio analysis. So in some of these cases, you'll have businesses that are required to file balance sheets. In those cases, there's limits to what we can do as far as scoring models, but we still have financials available.
We don't put out scoring models unless we feel comfortable we have enough data. We're not in the game of, we have one line of credit or one point on a company from 5 years ago or 10 years ago and, take a random generator and pick a score. We're not in that game.
We kind of try to think about it more along like almost the Hippocratic Oath, if you will, right? Do no harm. So we actually view that as being somewhat disingenuous to our customer base. If we're giving them an analytic that doesn't meet our own accuracy requirements, just to say, hey, we have coverage on this, I don't think that's the brand, right? That ends up creating exactly what happened at DNB, where you've got businesses getting burned by the scoring models when it matters most to them. Once you destroy a brand reputation, getting that back is years and years and tons of marketing spend. So we take that very seriously.
I asking this because, as you know, for my better understanding, what I try to do is to try to reach customers of the company that I'm researching to try to understand better the product and the service. Huh? This is because I'm asking you about Spanish customers. So last question in the chat. Richard Lopez is asking about, are you using AI to automate something? So are you using today or maybe in the future?
Yeah, so I mean, both of our models, the Frisk score and the PACE score, are already in AI machine learning models. They're not produced by analysts at all. They are fully mechanical scores. They're calculated every night, right, from a processing system. Addition to that, we do use AI in a variety of different ways, whether it be headline scoring for news articles, for NLP sentiments. We've been working with OpenAI language models since March of 2021. So those are things that we're doing. We also, one of the things that we're working through is probably the creation of our own LLM over time. I think what Bloomberg kind of did with Bloomberg GPT kind of put the writing on the wall there. If you want to stay competitive in these spaces, you're going to have to come up with, language models that are really trained on your specific use cases to some degree. So those are things that we're already in the process of developing.
Okay, Jerry and Mike, any summary words as a conclusion for this interview?
Quinn, I without trying to sound alarmist, I just would like everybody to know we are super concerned with what's going on in the world, and that this is very, very different than anything that's happened in a long time. Look, negative interest rates, nobody in their right mind would have anticipated that it would get up to $17 trillion, where somebody takes $1 and gives it to a country and is okay with getting back 95 cents in 5 years. Look, I'm an old guy. I've never seen that happen before in the history of mankind. And part of the reason that companies invested that way or bought negative interest rate, there was the buyers, because they believe that those countries, because they have armed forces, are never going out of business. And when they get that 95 cents, they believe that 95 cents is going to be able to buy $1.25 in goods and services, which is a very fancy way of saying they think there's a deflation depression coming. This is serious, big, expensive, well managed, on-sized trillions of dollars. Their bet is a depression.
I mean, the only other way to interpret that is that they actually think they're going to be trading out off the run on bonds, right? Because that's essentially the only other way to interpret that is, hey, I'm buying it. Obviously, the yield is going to continue to trend downward, which means the asset value is going to go up. And I'm going to be able to sell off that piece of paper before it's actually held to maturity. I think anybody who operates in the bond markets knows that's not exactly a smart bond strategy, right? Off the run bonds is not where you want to be playing as an institutional investor. You're typically not going to be making money on that. That's like playing vol, right? Why don't you
somebody has paper at the end. Again, at the end of the day, this is debt and loans. Debt and loans are very, very different than equity. Debt and loans, you don't make the payment, you're going out of business. This is not a joke. Debt is not a joke. That's got you got to be an adult when you start fooling around with debt. You got to be a really smart adult if you're going to take this much debt. Look, nobody's ever been up at these levels before. Let me tell you, anytime you get on the phone or you get on TV and you listen to talking heads or commentators, or you listen to the people running the Federal Reserve of the United States or the Treasury of our country or any of the countries in Europe. I want everybody to understand, none of those men and women have ever lived through or understand what they're talking about. Nobody on the planet Earth has ever dealt with this before. So when they come out and they have gray hair and they rub their chin and try to look sagacious, I'm telling you, we're dealing with show business. Nobody knows where we are today. I mean, nobody.
Okay, Jerry and Mike, thanks for your effort to be here with us, 1 hour with me and the people. I appreciate so much. And if I can help you to discover your company to the Spanish investors and Latin American, I'm really happy. So we are in contact and let's see what about the economics going on, right?
Yeah, Quinn, it's a pleasure to talk to you.
Okay,
Yeah,
see you, Jerry and Mike.
Everybody, we're very happy to speak with you and get to know you. So thank you again.
Okay, thank you guys. Bye.
Bye.
Yep.
Bueno, espero que os haya gustado la entrevista. A veces no se pueden preguntar las cosas de forma directa, como había alguna pregunta, como veis, no estamos hablando con cualquier persona, hablamos con el CEO, por tanto hay que modular un poco las preguntas o hacerlo de forma indirecta. Yo creo que ha respondido a todo. En algunas ha quedado claro que no quería concretar, por eso no he insistido. Pero la idea de la empresa queda claro. Hemos entendido el modelo de negocio, hemos entendido qué beneficia a la compañía y qué no beneficia. Por tanto, espero que os haya gustado. En el canal tenéis una tesis de inversión que hicimos, yo creo, hace un mes. Repito, una compañía muy pequeña, desconocida, sin cobertura de analistas. Por tanto, espero que valoréis el esfuerzo. Se ha conectado poca gente, pero, claro, la gente le interesa más Ray Dalio que una compañía pequeña, pero entiendo que esto es valor añadido, así es como yo lo entiendo. Por tanto, seguiremos haciendo entrevistas y, pues, si podemos ayudar a pequeñas compañías, tanto americanas como europeas, pues a que tengan más visibilidad, pues perfecto. Por tanto, os seguiré pues trayendo a CEOs, pero también os pido que ayudáis un poco pues compartiendo este contenido en vuestras redes sociales, hablando de ello, pues para que más gente pueda llegar. Acra Bolsa, gracias a ti por estar presente. Richard, gracias por estar presente. Javier Fernández, Juan Barrios. Yo creo que ha sido más interesante que ver el speech de la FED, cosa que aún no he mirado y tampoco voy a mirar hoy, lo dejaremos por otro día. Pero queda claro que es una idea, esto no es una recomendación, sabéis que lo hacemos como educativo, pero uno tiene que tener claro el entorno en el que nos movemos y, evidentemente, pues tomar sus decisiones. Por tanto, aquí tenéis una entrevista que a mí me ha gustado mucho personalmente. Yo había hablado antes 2 veces ya con la familia Flam. Ya sabéis que yo hago esto por vosotros porque yo ya tengo contacto con todos los managements. Difícilmente yo invierto en una compañía pequeña si yo no he sido capaz de hablar con el management, motivo por el cual no invierto, por ejemplo, en Japón, ya lo he dicho. Por tanto, no necesitaría hacer esto porque yo ya hablo con los management. Por tanto, si lo hago es para que el inversor privado, que sé que no tiene acceso al management, pues tenga acceso, participe, pregunte en el chat cómo hacéis. Por tanto, sé que gusta, lo seguiremos haciendo, pero a cambio os pido que me ayudéis a que esto llegue a más gente, pues compartiéndolo y hablando de ello en las redes sociales. Por tanto, me despido sin más. Ya sabéis, no hay directos hasta que termine el curso, finales de mayo. Por tanto, en junio calculo que empezaremos con nuestro directo semanal de jueves. Y no lo he comentado a lo largo de la sesión, pero el próximo martes 5 de mayo hay una presentación en directo a las 8 que va a ser la presentación oficial del Club de Inversión. Es algo que me han pedido gran parte de los alumnos de las 3 y ahora con la 4ª edición del curso avanzado. Yo no estaba seguro de ello, pero dado que ya hay bastantes alumnos, pues al final me he animado a crear este club. Este club no será solo para los alumnos, sino que también será para cualquier persona que se quiera apuntar, aunque no haya hecho los cursos. Y os invito pues el martes 9 de mayo a las 8 de la tarde en directo, donde os explicaré pues a lo largo de 1 hora y habrá un chat para que preguntéis cuál será el funcionamiento, qué es lo que vamos a ver. pero ya os avanzo que será un club diferente a los clubs que existen o más conocidos, porque ya sabéis que todo lo que tratamos de hacer en el canal es algo diferente y vamos a ir a la parte del detalle, de la profundidad, del valor añadido. Por tanto, espero que os guste y os espero todos pues, el próximo martes a las 8 de la tarde. Sin más, me despido y nos vemos, como digo, el martes a las 8 de la tarde. Un saludo, gracias, buenas noches.